evening and welcome. My name is Thomas Deely. I'm Program Director of Applied Analytics at Columbia University. I'm very excited to be able to introduce tonight's event. We have a very interesting and relevant topic with our spotlight on FinTech and financial regulation. I've just joined Columbia University from Goldman Sachs, and over the last couple of years I've become very involved in the domain of FinTech. In fact, last week I was at the Technology Web Summit in Lisbon, the largest technology summit in the world, where I had the opportunity to interact with key founders, investors and thought leaders on the topic, and we'll talk a little bit more about that shortly. At Columbia University, I'm Program Director for Applied Analytics, which is a brand new program that we're running for the first time in the fall. A master's program, and it's all about data, accessing raw data, to modeling data, to taking that wisdom to being able to generate action and results, which is a topic that is relevant and becoming relevant to all industries. I'd like to thank the Columbia Media and Marketing and Events team for putting together tonight's event. I'm very excited that we've been very much oversubscribed for this event for a few weeks, and it's an amazing turnout here tonight. I do encourage everyone to go to the Columbia School of Professional Studies social sites, Columbia_SPS, on LinkedIn, Facebook, and Twitter, and browse for the live stream. We're live streaming this event, and I encourage you to share with your networks. And please feel free to share your comments and follow on #ColumbiaFinTech. I'm going to introduce tonight's event, and I'm very excited to welcome our collaborators in the project tonight, Quaternion Risk Management and Tullett Prebon. The CEOs, Donal Gallagher and Frank Desmond, have flown in from Europe to be here tonight, so we're very excited about that. I'd also like to thank our collaborators and sponsors of tonight's event at Columbia University. We have 4 schools partnering with the School of Professional Studies: the Data Science Institute, the Business School, the Law School, and the School of International and Public Affairs. I'm going to give some brief remarks, and then I will hand over to Professor O'Halloran, who's going to give some context for our panel, and then we'll hand over to Ben McElhannon of the Financial Times. And we're very excited by the fact that Ben is here, but also the panelists that we've been able to convene. A very interesting mix of thought leaders covering academia and industry. 8 years ago, November 2008, the financial markets were in free fall as the aftermath of the Lehman collapse was unfolding. And one of the discoveries I had and many others had from that event was how little most financial institutions understood the risks on their books. And this was not just the smaller institutions, it also included some of the largest and most sophisticated financial institutions in the world. A topic that our panel will discuss tonight is whether that lack of transparency around financial risk continues to exist and whether there are opportunities to mitigate that. In Lisbon, one of the most widely attended panels was the panel on open source. And I had the opportunity to speak afterwards with Chris DeBona, head of open source at Google, based here in New York, Jim Zemlin, executive director of the Linux Foundation, and Denise Cooper, executive technology fellow at PayPal. And we talked about the opportunities for open source to bring transparency and efficiencies. A second comment I'd make is that to a large extent, model risk development continues to be developed within silos and within black boxes within the major financial institutions. And to a large extent, this is becoming more of a utility function. There are innovations, but more and more of that work is utility, which would benefit from sharing of standards, benchmarks, and collaboration. And a question we want to talk about tonight is the fact that this introduces inherent inefficiencies into the financial services industry. And more it's becoming obvious how the forces of technology are impacting industries which are inefficient and impacting incumbent firms within those industries. A final comment I'd make is that one of the most exciting aspects of FinTech for me is the opportunity it presents for public and social good. Whether that's access to credit for the unbanked or underbanked, or access to investment advice for people who don't fall into the high net worth individual bucket. Likewise, tonight we want to talk about whether there's opportunity for democratization of financial risk, and whether by sharing and collaboration we can level the playing field, improve the overall standards, and mitigate systemic risk. I'll now introduce Professor Sharyn O'Halloran. Sharyn O'Halloran is the George Blumenthal Professor of International and Public Affairs at the Columbia School of International and Public Affairs. She is also Chief Academic Officer at Columbia School of Professional Studies. A political scientist and economist by training, Professor O'Halloran has written extensively on issues related to the political economy of international trade and finance, regulation and institutional reform, economic growth and democratic transitions, and the political representation of minorities. Professor O'Halloran received a BA in Economics and Political Science from the University of California, San Diego, where she then went on to receive her MA and PhD. Her work focuses on formal and quantitative methods and their application to politics, economics, and public policy. Professor O'Halloran has not only been the inspiration around tonight's event, but she's also been the architect convening the communities and parties around this collaboration, demonstrating how a first-class global university can act as a catalyst, stimulating debate and the application of research around problem domains that are of broader interest. We started to create a community here at Columbia University, and I would describe it as a sandbox. And we're hoping other entities can feel comfortable to dip their toe in the water and join us without feeling their proprietary knowledge is at risk, and perhaps you may create something for the broader good of the financial markets. And let's face it, if we don't do this right here in Manhattan, the home of Wall Street, I question where we will do it. So with that, I hand over. Thank you, Sharyn, and looking forward to learning more.
So thank you very much, Tom. I really appreciate this. And I would like to thank and welcome everyone to our first panel of the Columbia University FinTech Lab. I would also like to thank and welcome Jerry Rosberg, who's the Senior Executive Vice President at Columbia University, as well as University Trustee Armin Avanasian. And we really appreciate you being here. All right. So my role, okay. I am the leadoff hitter, all right. So my job is to set the context of the larger debates around financial regulation and risk analytics, and the current push for new technological tools in the solution space. So let's just start, and Tom addressed some of these issues just quickly. In 2008, we had the financial crisis, and we could think of this really as a perfect storm of failures. We had Wall Street, regulators, hedge funds, government, politicians. We can go down the list. All of these played a role. And I think we can see these as a sort of a failure of each of our major institutions. And what was the government response? Well, they introduced a number of regulations to reduce risk, both at financial markets. And we saw this including a number of regulations such as capital buffers, leverage requirements, restrictions on derivatives, and so forth. The question that we really want to address today and to start understanding is the financial system more transparent, more accountable today than before the 2008 crisis? And I think have the regulations really been able to address that? Now, one of the industry responses to these new regulations has, as Tom alluded to, created a series of black box risk models. And these are being done in siloed developments without common standards, without use of collaborative approaches, and so forth. However, the types of regulations that have really been imposed really do require transparency and flexible analytics. And here, this has led to the emergence of a series of new types of tools and new types of approaches. And these emerging tools that we can see have looked at things in the solution space that are new and innovative, and ways that augment new and different types of estimates of risk, of these risk models, such as machine learning, natural language processing, and neural nets. Moreover, these different models require a different approach besides the siloed approach. They require one that's collaborative. That is, and we see that many of these new techniques have been developed in collaboration between academia, industry, and regulation. Now, just so that you can get a sense of what this might look like, we have actually, in collaboration with some of our partners at the FinTech Lab, started thinking about what it means to use open source, what it means to start introducing these new technologies into this space. And what we have here is an approach that tries to use open source risk engine, right? And what we created was a risk dashboard. And this is, again, all open source. You can download it, and you can download it at Open Source Risk. And this has been done in collaboration with our partners, Qualtarian, as well as TPI. And this is a cloud-hosted risk analytical model with data visualization tools, and enables risk analysis at the portfolio and asset class and counterparty level. Now, the features that we've really tried to emphasize here have been open source, collaborative, and shared standards. And this is, again, just one example of what that solution space could look like. And just to give you a sense of what the tool looks like, and this you can get this, you can go to either the open source risk engine or to the FinTech data science website, and you can work with it. And this just gives you a cut into what the tool actually looks like. And here, this is a screenshot. And the first top panels here just give you time series of the different types of trends that we're looking at. And the first panel shows the total exposure of the various risk parameters. And the second shows Monte Carlo simulations of exposure profiles. The second row gives you a snapshot of the portfolio, of the risk of the portfolio. The first dial is what I call sort of the CRO gauge, the Chief Risk Officer gauge, and it tells you, in fact, whether you have breached predetermined limits of risk limits of your portfolio. The second set of dials, again, just break it down, give you different types of risk indicators in your portfolio. Here it's broken down into credit levels, and then credit rating levels, and then again you can just see the different types of risk measures that are being allocated there. This can be done also at the counterparty level as well as the netting set level. And when you go to the site, you can go ahead and play around with each of these. Now, the risk dashboard, again, provides one open source tool for researchers, industry, and participants, as well as regulators, to track changes in institutional risk. It establishes what we want is a benchmark and best practices and protocols to tackle key issues such as the impact that alternative policies or alternative regulations could have on overall risk or systemic risk within the system. So, what are some of the next steps? Here, what we want to do is really build out a community that's dedicated and interested in building out these open source tools. And these are people that are not only quants and developers, but also students who are interested, as Tom was talking about. Our applied analytics and enterprise risk management students are also interested in using these tools. And this is a first important way to start training people in this area. And for more information about this, again, you can see the different tools and some of the research around this at the Data Science Institute, and you can download the different open source engine at Open Source Risk openriskengine.org, and then some of there. And then I just wanted to thank everybody, again, our collaborators as well as our different sponsors for their support. Okay.
So thank you, Sharyn. I'd like you to join the rest of the panelists as we move on to the panel discussion. A note for the audience, we will have a Q&A session following the panel discussion. It's now my pleasure to introduce the moderator of our esteemed panel, Ben McLenaghan from the Financial Times. Ben is the US banking editor of the Financial Times. He's based in New York. And in this role, he covers Wall Street and he leads the Financial Times US Financial Services team. Previously, Ben was US financial correspondent and a correspondent for 3 years in Tokyo, where he focused on capital markets and economics. Prior to this role, he covered Asia for the FT's Lex column, based in Hong Kong. He joined the Lex team in London in August 2007 from Institutional Investor magazine, where he served for 2 years as London correspondent. Before that, he was at The Economist Group, writing for a range of publications, including CFO Europe and Intelligent Life. Ben graduated with a master's degree in English from Cambridge University. Thanks.
Well, thank you very much, Thomas, for that introduction. I'm going to ask each of my panelists in a minute to give a quick introduction to who they are and where they've come from, perhaps not quite so long as that one. But thank you again for having me along tonight, Sharyn. Very pleased to get out of the office, and especially now when there's a single topic of conversation back at FTHQ, and there's no surprise, there's no prizes for guessing what that is. And please, my tie tonight, I've taken a lot of teasing for this already today, but please rest assured it has no bearing on any particular political leanings. So tonight's discussion, as Sharyn said, it will end with a Q&A, or perhaps just involve a Q&A at some point. So please, if you've got any burning questions at any point, just put up your hands and we'll steer discussion your way. But Thomas was good enough to send me a list of areas we should be covering. And just to give you a quick rundown before we introduce the panelists, we're going to begin, I think, with industry collaboration, look at the ways in which banks have been trying to work together, banks under constant pressure to improve margins. To what extent can utility models really help? We'll be looking at open source software, which is something I've talked about with Goldman in the past. It's doing lots of collaborative work on an open source basis with lots of its rivals. We'll be talking about model risk. That's a very topical thing today with the the Government Accountability Office taking a few pot shots at the Fed, saying its stress test for the banks could be a lot more transparent and it needs to show it's working a bit more. We'll talk about regulatory reform. And again, at any point in this, please butt in and ask questions. We'll be talking about technology trends. We'll be talking about FinTech. I tend to focus on the online lenders, the robo-advisors, and blockchain, the big three, it seems to me, but we can cover whatever you want. And if we have time, we'll be asking about academia, what role academia has in all this, and then maybe we can solve the future of finance at the end. But before we kick off with the industry collaboration, please, turning to my right, Emmanuel, please introduce yourself.
Okay, my name's Emmanuel Durman. I'm Columbia bred through and through. I got a PhD in physics from Columbia a long time ago, and then I worked in industry. I worked at Goldman Sachs for 17 years, and then I came back to Columbia in 2003, and I run the financial engineering program in the engineering school.
I'm Paul Glasserman, a professor at Columbia Business School. I'm also involved with the Data Sciences Institute at Columbia. I chair the Financial Analytics Center within the Data Sciences Institute, and we're happy to be supporting tonight's event. And for the last 5 years, I've also worked with something called the Office of Financial Research in Washington. It's an independent agency that's housed within the Treasury Department that was created by the Dodd-Frank Act. So while I'm very far from being a regulator, I may be the closest thing to being a regulator on this panel.
Good. Brian Ruan from BNY Mellon. I lead our clearing and collateral management business. And the last number of years, I've been involved together with the team at BNY Mellon, and perhaps many of you in the crowd, to restructure and to repurpose the repo market through a task force for the reform of the tri-party repo markets. And I think that's entirely appropriate given that BNY Mellon is the largest clearing and custodian. So I'm happy to talk about that and other things. So thank you.
I'm Mayur Thakur. I run the analytics part of compliance at Goldman Sachs. I've been at Goldman Sachs for about 2 years. I don't have a finance background before this. I used to be at Google for about 8 years. My background is in computer science. I got a PhD in computer science. I used to be in academia, so I am kind of from that side originally as well. So yeah, I've worked with, I know a bunch of FinTech companies as well. We talk to them a lot.
Sure.
Well, thank you all very much. Let's begin with industry collaboration. Since I've come to the US, as you said, about 18 months ago, I've been focusing on the banks every quarter, looking at their quarterly results and seeing the return on equity, the most important number we like to focus on, falling short for just about every single bank you can care to mention. The only one that's going to hit their double-digit target for ROE this year and next is Wells Fargo. And you can question to what extent Wells Fargo is, well, how it's getting there. So let's talk about the potential to improve margins by collaborating. I'd like to begin with you, Brian. Okay. How is BNY joining forces with its deadly rivals to improve margins?
I mean, more than people realize, there has been a lot of collaboration. And if you go back even before the crisis, as the industry evolved, say, settlement practices, there was industry collaboration. But in the aftermath of the credit crisis, and if you read any of the literature on it, at least one of the proximate causes of a number of the failures was that secured finance was abruptly withdrawn from them. Now, the firm may have had an asset quality problem, a solvency problem, but the proximate cause of their difficulty was that the repo markets dried up. After the financial crisis and the recapitalization that took place through TARP, a committee, which was an industry committee, was formed to restructure and to look at the repo markets. The committee was made up of about 35 members. There were some that came and left during that 4 years, but I would say all of the companies that were involved stayed in it. And during that period of time, there were 35 recommendations that came out of it. The practices essentially took the repo market from an operational market to really a technology and a data market over the period of that 4 years. Very substantial investment took place too, but again, this was not a regulatory edict, but it really was the desire to really make sure that you were not, as an industry, going to have a recurrence of that. And I'll hit 3 sort of points that kind of came out of it, and they have subsequently come into regulation, but I think they do tie back to that. So first was more transparency about how the market works from a settlement perspective. That was a market that people who had experience understood how it worked, but there really was no formal documented practices and procedures. So for example, there was no confirmation process of a trade. Everything was verbal, yet it was a $5 trillion market. Unusual. Today there's a confirmation process. We're all parties, and it actually went beyond that. It's now a very granular technology-based confirmation process. The second is the market was 99% overnight. That's really less of a technology issue and more a core finance issue. Big banks, long-term exposures, primarily financing themselves overnight. The data that was harvested from that was really used, together with regulatory input, to make sure that banks lengthened their borrowings, their commitments, and that investors understood the collateral they were getting. So it was really a perfect match, if you like, of the traditional mutual fund and the dealer model. At the end of the day, less trading, longer-term finance, more expense. And then I think the third element of it that I would say is that intraday risk, which was really mammoth in that space. It was in the trillions of dollars. Because it wasn't technology-led, the market used money to move securities around. In the aftermath of the reform of the repo market, it really was technology, and you did not need anything like that amount of intraday liquidity. We were involved in an effort that over a period of 4 years removed 97% of the average intraday liquidity, an astounding amount of capital that was freed up. And so that's one example. There are lots of other examples. Say, for example, in the derivatives arena, But in wholesale funding, I think it was certainly regulatory encouraged, but the industry did get together and work together on that, and I think it's been largely seen as being one of the successes.
Are there any more examples of organic efforts by the industry, perhaps?
So I can speak to what Brian was talking about is the more of the operational risk. What I deal with, what compliance deals with, is more of the regulatory risk, which is the risk the firm has from people or clients not following regulations, for example, right? Doing something that they're not supposed to do. Now, in that space, to my understanding, a couple of things I'd like to point out. In my space, which is essentially looking at a lot of data, building surveillances, suddenly because of regulations and because of the financial crisis and the realization that we need to do more, there's a lot of work to be done. This is partly related to the rise of FinTech industry as well, right? So we're doing all sorts of big data and all that stuff. That's really why I'm here as well. In that space, if you kind of parse it out and say, okay, technically speaking, there are two things, right? There is the data and there are the algorithms, right? And both, from just my personal view, the algorithms are kind of nascent if you compare, for example, to well-established industries, right? At least where I came from. So my understanding is that a couple of points to your answer is there isn't a lot of collaboration in that space. But I would say that is to be expected because it's kind of still new, as opposed to, for example, market risk or operational risk and stuff like that. This way of looking at regulatory risk is rather new. Regulatory risk is not new, but this way of the big data approach is new. And to be honest, one of the biggest things that our team, like I'm facing, is not even the model risk, which is kind of one of the things that this is about, is just understanding our own data. It's very complex, right? So if we, because what we do is we get data from all across the firm, and the firm is pretty diverse, right? So I don't see a direct way right now of collaborating with another firm, right? Because we need to get to a point where we are much more stable, where we are where we understand, have all these processes. Right? To be honest, we have made a lot of progress in this space, but there is a lot more room to apply the techniques that have been applied elsewhere to this. So again, to wrap up, I don't believe there is a lot of collaboration, but that's to be in some sense expected. But I do expect in the future that we will see more collaboration.
With your quasi-regulatory hat on, is there a quasi-regulatory answer to that?
Well, I mean, I think there's maybe an opportunity, and it relates to some of the earlier comments, and that's around data standards. I think that's an area where the industry has a lot to gain from collaboration. I mean, two specific examples, and one that indeed the OFR was involved in the early days is the LEI, the Legal Entity Identifier, which is like a social security number for every legal entity in the world. Lehman Brothers fails. What's your exposure to Lehman Brothers? Well, Lehman Brothers isn't one company, it's thousands of companies, and they don't all have the name Lehman Brothers in the name. So how do you know at that moment what's your total exposure to Lehman Brothers? Well, if we had a universal system of legal entity identifiers, then you could very quickly know every entity that you'd have a clear identification of every counterparty for every transaction and how they're ultimately related to some parent organization. I think there's been reasonable progress on that. I think an even more challenging problem is around product identifiers. So to solve some of the problems of sharing data across firms, well, part of the problem is different systems obviously aren't going to talk to each other. And this is something that the CFTC has put some effort into, but I don't think they've gotten very far, to have a way of replacing a PDF file that's 1,000 pages that specifies a complicated derivative security with something that a machine can understand, so that you can get to the kinds of things that this open source software. If you want to be able to build on top of that in a way that different firms will be able to use it, there needs to be a universal language for how contracts are represented, and therefore the risk can be measured.
Emmanuel, you want to come on this one?
No, I'm going to wait.
Fine. Well, you mentioned open source there, and so that's a nice link into in the second of our list, which is the extent to which banks could or should cooperate by using sort of shared software. I mentioned Goldman. I spoke to Don Duet, who I think now runs the tech function there, about a year ago. He was talking about a whole new dimension. He said there used to be a buy or build decision. Now it's a download/buy/build decision. So anyone want to start on the benefits of open source collaboration? Why not?
So in general, I will say that I'll give it kind of two answers, right? In general, I think open source has been great. I have a tech background, in case you did not notice. So yes, in general, like Linux, I've spent all my life Linux. All that stuff is great. However, it depends on the maturity of. This is kind of again to the former point I was trying to make of your area essentially, right? So if the standards, by the way, I completely agree with some of the stuff that you were saying, that products, entities, all those things can be and should be. Why we're not doing it, I don't know the answer, but yeah, that's completely, that's a no-brainer for me, right? If someone solved it tomorrow, I'll be super happy, right? Now, coming back to the open source versus non-open source, so if you think about the problems in regulatory risk space, right, that we face, when we have when we're trying to build a model, basically what we need to do is we need to figure out what's the baseline, right? What's the relatively easy to code things up? What is that approach? Now, I'll give an example of natural language processing, which was up on the slide. So we work with a lot of email, chat kind of data, right? And there are multiple very good open source libraries. Like there's Stanford NLP, which is very standard. There's Open NLP, that is very standard, right? They're very good. Now, when we come up across a problem, let's say the problem is of detecting entities, right? An entity could be name of a person or name of a company, so on and so forth, right? Now, we have done in the past, we have used open source, and we get reasonable results. But the point is that if you get 60%, that's not good enough for us, right? 60, 70% accuracy is pretty good to write a paper, for example, but it's not good enough for us. Now, the question is, do we build upon that, or we write our own? And we have found by experience that if we spend maybe 2 weeks, we can beat that system. And it's easier for us because it's not like we're smart, it's just that we just know our data better, right? And so that's why we tend to go with, at least for some of these areas, where a priori you would say, or just from a distance you would say, oh, why are you building your own when there are good open source tools? And that's the reason, because we don't want to stop at 60%. We want to get to 90, 95%, because this is really a matter of risk. It's missing one email, right? That could be, that's a potential risk to the firm, is very risky, essentially, right? So that's the reason for us. And again, it's a maturity question, right? In market risk, I don't know much about it, but if you have standard models, if the things are standardized, maybe it's the open source is the way to go. And if this becomes more standardized, because think about it this way, the people who designed Stanford NLP, they're computer scientists with my background, but they are not financial people. They are not working on the same data sets. There is no reason to, right? But if they had tuned it on the same data sets that we had, maybe things would be different, right? So that's kind of my on the other hand, this on the other hand.
Is it a bit of a red herring in a way, in the sense people talk about open source a lot, but people talk about open source for widely used things for a good reason, so people can add to it and build communally on it. But I'm not sure whether this isn't some kind of knee-jerk sort of thing to saying everything that banks do should be open source. I guess I'm asking, what's the rationale for this?
I'll put in a plug. So I don't think it's necessarily for everything, but I think what's very valuable is to have benchmark models.
Yes.
And so I think one lesson of the financial crisis is that different banks were measuring, say, risk-weighted assets on representative portfolios in radically different ways. Whereas the assumption was that they would have been more or less agreeing on that. You don't necessarily want everybody using the same model. That's not a good outcome either. But I think it's very valuable to have benchmark models that you can see, ideally with some disclosure, where are different banks in and how they're measuring different types of risks. How do you get to benchmark models that everybody can agree on and everybody can use? I think the only way to do that is through open source. So there I see open source as not an end in and of itself, but it's a solution to a broader problem.
I mean, it's not going to supplant the existing models, proprietary models that each of these firms are going to use, but definitely it's a way in which you can complement if you're trying to either have a benchmark or you want to know an industry standard where you get anonymized data that can be fed in, and then you know on average, given these type of common measures, where the industry is, and then people can be measured off of that. Those, I think, are very useful utilities that I think open source can play. I do not see them supplanting proprietary models, but I think they're very, very complementary. Moreover, they do help the Fed in understanding how to benchmark as opposed to stress tests individual firm by individual firm, where they really, it's very hard to say compare apples, because each of these firms are not the same.
So is the regulator enlightened on this? It sounds like.
The regulator should be highly enlightened on these, and I think it gives them another.
Should they do it with suspicion then, when banks get together behind closed doors to do things in concert?
I think giving regulators more tools and more enlightenment is a positive thing, and it provides another sets of dialogue. It also provides better ways for people to understand their data, to understand the different types of measurements that are out there. And I'm positive everybody wants to converge towards optimal risk allocation and good, stable environment. So given that's the case, everybody would be better off.
I think that's an assumption we'd all like to believe, but the 60% may be good enough for some people, unfortunately, and as a result of that, what's a benchmark may be some people's reality. So I don't know, just throw that in there.
Sorry, what was the point?
The 60% off of right. So so when he does the probability of success on each of those, on those models, what he's saying is that
What I'm saying is open source, right? Open source is no model.
he does not understand.
Some institutions, smaller institutions probably, will utilize open source to their hey, you have the ability to find the budgets to go and put proprietary pieces together. So that's all I'm saying.
I see.
So if it's
We're talking about the largest banks,
Yeah.
Yeah.
Okay.
institutions in the world, but the reality is there's still 6,000 banks.
Yeah.
Still 7,000 countries.
Yeah.
So
I-
let's try to calibrate where we are.
Yeah.
That's all.
So if it's for me, I completely agree, right? So I was just stating that, assuming the question is for me. Okay, yeah. So I'm saying, yeah, if quick and dirty, if you want to do something, yeah, open source is great. But typically we have found that in our circumstance, we want to go beyond that. And we have tried it. Let's just say the reason I said that is there are actual instances where we actually tried it. But then we said, okay, now if you have to improve it, it's much easier, like just from an engineer's perspective, to build something, spend 2 weeks building it, because then you can improve it much better. That's what I'm saying. So if you don't have resources, right, if you just want something out of the box, yeah, that's 60 is better than 0. Exactly.
And you can augment over time. You can.
Goes back to the point that where do the regulators come out? And the point about them being well educated, saying some of the guidelines and standards is also an influence as to whether or not 60% is good enough.
Right.
That's her.
Thank you.
Point taken.
I get that.
There's one over here.
Firms tend to have a certain dollar that they can apply to doing their risk management.
Mm-hmm.
And if they spend some or all of that dollar dealing with what's referred to as a benchmark, with the assumption that, even with the assumption that it can improve in a linear fashion, they might all be fooling themselves and the market as a whole. Because here, each firm's real responsibility is to make sure they don't blow up during the next financial crisis. Because if they do, it doesn't matter if the rest of the world is there from their perspective. So they have to make sure that what they do and where they spend their money is carefully thought out. And if all the benchmark does is improve the Fed or other organizations that are supposed to be keeping track of things, but don't seem to be doing such a great job, anyway, then it shouldn't be spent in that fashion.
Does that sound right to you guys?
I let the bankers answer.
I would say that I think it's at an early stage, and I agree with the two comments that are you can't outsource your risk management, which is what you're basically saying. On the other hand, not necessarily open source, but access to tools for smaller firms when they become the established standard through things like at BNY Mellon, we've developed an app store that we're delivering through a new gateway that we have called Nexon, where people have options. It doesn't mean that it's their sole form of managing risk. It really is an option for them to gain access to it when maybe they're of a size or a stature or their financials may not justify them being able to do it themselves. I agree you can't outsource it, and it shouldn't be that you're relying wholly on a different benchmark. But on the other hand, access to world-class say risk or even CRM systems or other tools that are out there to smaller emerging firms through shared technology makes sense.
I'm going to press on now to talk about model risk, which is always a question that seems to arise in the FT probably more than most others. Do people put too much faith in models?
Yeah, I will try to say something about that. Actually, I was listening to what people were saying here, and I think people have a tendency to over-quantify things. Sharyn was talking about rational, what did you say, optimal risk allocation, and I actually don't quite know what that means, optimal risk allocation. I think it's a fiction. And when you talk about 60%, a model capturing 60%, that may be true for natural language processing, but not for risk management. I don't think you actually know how much of the future you're going to capture when you build a stress test or a risk model right now. And so I'm always bothered by not throwing out the baby with the bathwater, but drowning the baby in the bathwater. It's good to be analytical, and it's good to build models, but I think one of the failures of 2008 was that people took those models much too seriously because they were phrased in very mathematical terms, and they use a language similar to the language that people use when they build my iPhone, but my iPhone actually works all the time, and those things don't. And basically, people tend to forget that they're working, that when they build a model is really, I'm going on a bit here, but that when they build a model, they're not modeling a physical system, they're modeling a social system. Markets are social. People can do whatever they like at some point. Even the words model risk make it sound like you can quantify the model risk. But the truth is none of these models actually describe the world the way they are. And when you write them too precisely, you tend to forget that they don't actually describe the world that you're talking about. So it's easy to say, but very easy to forget.
It seems to me that the Fed in particular, the
Yes.
current cast of characters of the Fed, seems to place a lot of faith in the ability to devise models that work.
Yes,
Is that
saying about the current cast of characters at the Fed in particular seems to place a lot of faith that the models they devised are the right ones. Are we headed down the wrong path?
Yeah, I think it's a kind of, if I can be a little metaphorical, I think it's a kind of idolatry in the sense that people try to write down an equation that they think is going to describe the way markets behave. And it's like Pygmalion. You think it's going to come alive just because you wrote it down in 1 inch, but it's actually not true at all. And yeah, I think it's dangerous. And if you work, which I have on Wall Street or in asset management firms, the really smart people know how to use models, but they know also how to look through the model to what the actual risks are. I think the idolatry is thinking that there's a formula that will save you from using your intelligence and using your perception about what's going on in the world and looking at what's happening. And if you talk to people who are actually in the business of managing assets, they're looking at what's happening every day and trying to figure out what might happen. And they may not be right, but there's an activity to it which using a model and turning a crank doesn't capture.
So is there a need for more humility in banks and acceptance that however many terabytes of data you've got, it's not going to tell you the whole story?
I mean, I completely agree, right? So if you think about, at least from my perspective, you think about compliance, right? I was describing the model building itself, right? There's a lot of data, I know those are new things that we are doing, right? A lot of the, if you think about the inputs that come to my team, right? They come from observations, right? From humans. So how to prioritize, what to prioritize is driven by people, mostly, right? The people could be within Goldman, they could be outside of Goldman, right? Regulators, so on and so forth, right? So I completely agree that, it's not the end. And every single model that we build, so that may be, so that I try to say that in the beginning, when you have regulatory models, right? So the regulatory risk model, every single model that I build, the output of that is looked at by a human being, a risk officer, right? They'll do the investigation, so on and so forth. That may be different from what other people, and I'm not an expert, right? So there's always a human element to it, right? So what I was trying to say is that, for example, because it's for most of the problems that we have is a needle in a haystack problem, right? You have a tiny thing in a big amount of things, right? You have 10 trades out of 100 million trades, things like that, right? If you stop at 60%, you're not going to be able to manage that. And that's what I was trying to say, right? If you get 60% of it right, but the remainder of the 40% that you didn't get right, we strive to get that as well, right? And that's why that was the logic I was saying is we'll build proprietary models. Now, who decides finally that this is risky or not? There's always a human in the loop. It's not automated completely at all, right?
But
so,
you don't sound like you're talking about financial risk problems. You sound like you're talking about analyzing data. You sound more like you're talking about Amazon click kind of problems than what should I do with my portfolio today?
That's right.
So yes, what I'm talking about is regulatory. So for example, someone lying in an email, things like that, right? That's very different from computing betas and stuff like that denotes. So that's why in the beginning I said there are different types of financial risk: market risk, operational risk. I was talking of regulatory risk, like compliance specific risk, right? That's why. That's exactly what I said in the beginning, that it may be different and it may be the newest focus of these three risks, right?
Okay, but I agree with you, but the problem you're tackling has a definite answer of whether it's right or whether it's wrong.
After investigation, yeah, we should have an answer.
Which isn't the case with a lot of the other things we're talking about.
Yeah, exactly. That's the difference. Yeah.
Yeah. I was just going to say that if you take the point that you made about the regulatory risk and you sort of went down the risk paradigm and looked at technology or operational risk, while it's not models that direct whether you should be investing proprietary dollars, with many of the businesses that have invested heavily in the digitization of either the processing or settlement of activity, some of these predictive analytics tell you much earlier in the day if there's a problem that's going to affect you, say, at a settlement time later in the day. So where it may not, as you said, work from the perspective of you being able to see what risk you're taking or what the risk in the social element of the world is, where you can measure it. So I think today, many operations, you can measure every entry. You know why, if it's being held up. If one of our clients is having a difficulty, you can actually see it through predictive analytics. I think in the operational and technology risk, it is quite useful, and the development of some of those tools actually help you to get to a problem much earlier.
Okay. Anyone? Yes, over there.
What do you think has been the impact on the cost of finance by building these new models and spending a lot of money on sort of the regulatory aspects, measured by sort of fees to people who pay for investing in funds, or even by return on equity for the banks? Is it, in most industries, technology has sort of a positive effect on that, but is that the same for finance?
That's a tough one. Who wants to handle that?
Is it the technology or the change in regulations? Right? I mean, if you have higher capital requirements, return on equity is lower. But I don't know that I would say that that's a technology issue.
Is the burden beginning to come down 7 or 8 years on from the crisis?
The cost of compliance would be one issue.
So I'll give you kind of a non-answer, right? So if you think about But it's the honest truth. That is what I say. So if you think about, we get this question, how do you know you guys are effective? And the honest answer is we don't, right? So how do you measure, like I'll be like an engineer, like how do you measure the fines you did not get? There's no way to do that, right? So yeah, the honest answer is we don't, and that's why in like we have to have other metrics, right? So if my job is to build models that that are looking for these needle in haystacks, I'm basically saying how many needles are you finding versus the rest of the non-needles that we are finding, right? And that answer is a human being answers this question. We give it to let's say you guys are all compliance officers that are using my model. I'll ask you. I'll go literally do ask you. I showed you 10 things. How many of them were true positives? How many of them were not true positives? Things like that, right? So that's and we track it year over year with more things. But to be honest, we don't have that numerical answer because I don't think anyone has that answer.
Maybe I'll just add, again, I think the cost of compliance has been enormous. But if you think about some of the major initiatives that have come through, so the first one which we talked about, which is that banks can continue to fund themselves in a time of duress so that depositors and investors aren't adversely impacted, that's probably positive. The whole thing about how you weigh up the cost from the perspective of an investor, there's an element of expense there. Segregation, that whether it be throughout Europe where in the aftermath of Lehman, it wasn't clear who owned certain assets. The CAS rules in the UK are cap rules, which require financial institutions through technology to be able to go down to the CUSIP, which CUSIP or which securities belong to individuals or institutions or pensions. All of that I do think is good for the investor. The cost-benefit component of it, I think that's probably one of the topics that's really being discussed in the industry right now. I do think there are many of them that around capital adequacy and that have done good, but it has brought down the ROE on those banks because of the costs.
So where have regulators overshot? Where does the next administration need to pare back? Never mind who's running, who's the personalities involved. Where are the real pain points that need to be addressed?
Well, part of the problem is
An academic should take that one.
Yeah, that's why I jumped right in. I'll just go and talk. Yes, like academics too. Part of the problems is I think the capital buffers are actually one of the strongest points that we have. The resolution, I think, is actually just clarifying those issues are important. There are other issues that I think have been very cumbersome, such as just a lot of the overlapping authorities that have created a lot of confusions around different regulations, reporting requirements, and so forth. So there's a cost to compliance, but it's also how you comply that just makes it very difficult, both for the firms and the regulators to do their jobs appropriately. So cleaning out those types of things into the smart regulation, pro-market regulations, I think would be very helpful, and still maintaining, though, a lot of the basic foundations of the strong capital buffers, safety and soundness, and wanting to have transparency within the both understanding institutional as well as systemic risk as being key indicators.
Anyone else want to opine on regulators helping or not helping in the pursuit of using data to analyze your business more effectively?
I was going to just make a meta remark, which is I haven't really worked actively in risk management for 10 years, although I sometimes work for some hedge funds. And the issue's always been valuation, and I realize how out of date I am now because everybody's talking about compliance, data, regulation, things that aren't connected with valuation at all. And I understand that, but I'm a little shocked at how the focus has changed from are mortgages really are pools of mortgages really AAA to how do you catch lying employees?
Yeah.
It's kind of interesting.
I'll just say that regulators asking questions in general is a good thing, right? Because it forces us to also ask the same questions before they do. Right? That's the approach we take, and the more questions about data and what did we do, what we should have done, the better, right? Because really that is the approach. Like, what should we be doing, as opposed to what's the bare minimum we should be doing, right? Of course, you want to do the bare minimum at least, right? But beyond that, there is a reputational risk to the firm, and we always take that approach that we should be covering all these risks, right? As in any firm, you'll have to prioritize and stuff like that, right? So more questions, my perspective is better, actually. It's good.
What fraction of the people in a typical firm like yours are devoted to those kind of issues?
You mean what's the size of compliance?
Yeah. Or people involved in compliance and regulatory. Out of how many 30,000 people at Goldman?
36.
Yeah.
36.
I mean, I would say that that it would be everybody, right? Because the way that it works is that that the first line of defense in risk and compliance is actually the business, right? So that I would say that part of the reason why there's so much talk about this, that the business is looking at that, is because it really is, before any other element, it is this something that reputationally we should be engaged in? Is it both in the US and in markets where we operate legally compliant, as well as does it meet our risk? But it's not, you can't staff, I think, large enough in risk. There used to be sort of a risk department, an IT department, and then the business. And now I think the business is the risk department and the IT department. And that's how the industry is progressing.
Yeah, a little data point from my reporting last week on Goldman Sachs. When they made up, I think, 80 odd new partners, 6 were from compliance and legal, which is a record high. So to that extent, it is getting more recognition inside. And Paul, you wanted to come in?
I was just going to say, I think going forward, and even now, probably the biggest challenge for the regulators is going to be, as a lot of financial services moves out of the traditional firms, Goldman Sachs, BNY Mellon, into things like FinTech operations, right? I mean, that's going to be a challenge. How are you going to regulate banking when the payment system looks nothing like what we have currently through the banking system? Even lending is going to look starting to look different, could look very different a few years from now. And are the regulators going to be able to keep up with a rapidly changing financial services industry?
Yeah, that's a very good line to pursue. Sharyn, you mentioned the overlapping authorities. Is the infrastructure right now in the US sufficient to keep abreast of the rapid changes in fintech?
No. I think that's part of the problem, and that's why having these collaborative sources and activities between OFR, academics, and different types of folks in fintech working in this is really important, because it does start allowing people to benchmark, democratizing the tools and making it available, and making sure that people understand, even though I understand optimal risk may not be, quote unquote, ever achievable or understandable, it's important to understand where it's being lodged and how it can be measured and where it is. And that, I think, is very important for the regulators to have tools to be able to do that. And those tools are shared and they're available even when firms have their own proprietary models. That I think is the realistic goal.
Are regulators working collaboratively enough?
We're all trying.
Well, the OCC seems to be leading the charge, right, with this new fintech charter. Would that, I mean, no one knows what it looks like yet. It may emerge sooner rather than later, but is that a step in the right direction?
I haven't seen it. I'm sure it has to develop more. I haven't seen it implemented yet. I don't know, Paul, if you've had more experience.
No, but certainly the first step is to pay attention to the issue. So yeah, it's certainly a step in the right direction.
I think that just generally the whole, if you think about how the financial markets work, whether it's payments or whether it's securities, ultimately those investments have to go through and settle at a central bank. And so given that it has to go through and settle at a central bank, whether it's money or securities or derivative, ultimately that's how value settles. There is a manner in which there can be, it could be regulated either through member banks or through member brokerage firms. I also think that many of the big banks have built out what at one point might have been sort of shared services or vendor programs to really include what are the standards that are acceptable for FinTech partnerships. And I think that while it's at an early stage, I think that is probably the basis for how big institutions will partner with startup firms going forward, many of which I think are interested in partnering with them, but they've got to address and make sure that the way they're partnering is in a way that makes sense from a risk perspective.
Right. I mean, even though the regulations are trying to push everyone onto the clearing houses, exchanges, it's not clear that that's going to happen given actually the nature of these different types of instruments that are developing. So it'll be interesting to see how that works and whether in fact that becomes the way in which clearing and regulation can take place, or do you need different hubs, or do you need different modalities? I just don't know that, but you definitely need a bunch of different tools to be able to address the emerging technologies.
Brian, were you arguing for the Fed to play the leading role in monitoring FinTech full stop?
No, the point that I was making was that as it relates to even if there's emerging technologies or alternative lending programs, ultimately, to the extent that it's cash or that it's money, those are still, they're not in a shadow economy, they're still there. There are definitely, some of them are threats to banks or established players, but they're there and they'll be captured through the SEC charter, or they'll be captured through how big financial institutions who partner with them develop protocols around who they're going to partner with. So it's not arguing for the Fed, it's really just saying even new innovative technologies like financial technologies, if they're going to clear a bond that's denominated in dollars or in euros, it does ultimately clear through the Federal Reserve or the ECB.
Can we talk quickly about partnering between big, crusty retail banks and some of the fintechs? I wrote about Wells Fargo today, which is partnering with a company called SigFig, which is a sort of white label robo-advisor platform, and this seems to me to be Wells' big entry into the robo-advisor space. Do you see more and more of that happening? For the big banks going down the partner model rather than buying something outright or building their own?
The academic. So it's interesting. So if they want, I haven't figured out why you would do that yet. I mean, if you think you're going to have an arm's length relationship, I think the regulators will think not. So I don't believe that's going to insulate you from different types of compliance and so forth. So that
Agree.
idea doesn't really flow from in my thinking. And the only other reason is that you think that they'll be more innovative and you're really setting up an incubator. And if it's that, then I think that is an interesting path to pursue, and we'll have to see how that develops and whether the two types of cultures, like a Wells Fargo, which is usually considered a very well-run bank, usually, and something that's innovative, and I don't know what the standards are, whether those cultures will clash or whether they'll be able to coexist and do well together.
I mean, in terms of risk itself, right? If you have a vendor product, at least if we have used vendor products, right? We don't think of it as an outsourcing risk, right? We still own the risk. So does that factor into the decision? For sure, right? But we never think of it as, if that algorithm fails, it's still on us, or at least in compliance. And to the former question, I think it's hard to predict the trend, and big banks or big firms tend to be diverse enough that decisions tend to be made kind of locally, right? So if it makes sense, so it's hard to say in general whether they will partner or not, or Goldman or whatever it's. But in my field, I can say that at least as far as compliance risk is concerned, if we use a vendor product, we don't think of it, not at all, right? Which may be one of the reasons that we tend to use less of it. The other reason being that if you think of new technologies and you think of the models they're developing, they're mostly in, at least again, I'm qualifying everything by saying my space, it has to be data driven. And new firms, they don't have the kind of data that we have, and that's just a fact of life, right? And so it's the same thing, argument in some sense that I made with open source that I'm making with vendors, right? So we talk to a lot of them, and I'm generalizing a little bit. So certainly there are lots of good things that are coming out, but they tend to have this issue that they want to partner with us, and it's a good thing probably for us as well. But the models need to be tuned to the data that we have, right?
Yeah, I can think of two different models. There's the Symphony model, which you guys are pursuing in collaboration with a dozen or so investment banks, and there's also Marcus, the online lending effort, which you're developing on your own. So a variance of roles.
I would just add, I agree with that in terms of whether you're co-investing or co-sponsoring, or whether it's a vendor relationship with some of these emerging technologies. The large institution takes it as if it's their own in terms of setting standards. The other thing is, obviously, these emerging firms get access in the end to companies that have both resources and have clients that have a need. So the type of example you gave, I would say that we're going to see more of that.
Any more questions from the floor before we talk about academia? Go right ahead.
So I want to touch on, a lot of people mentioned capital regulation tonight. So I think like the view you're asking about the regulator view is, so I guess in Basel Committee, a lot of Basel IV is the removal of models. So a lot of the things you had on the dashboard tonight, so your CVA, your counterparty credit risk, operational risk, the view is to move away from models for that. And I think the view from the Fed was that you would eliminate models completely. So do you think the elimination of models and just go to a standardized view for all the banks, so similar to a Basel I approach, is better than building a baseline and then building kind of proprietary on top of a baseline?
I want to jump in on that one.
I think you actually, well, I actually think benchmark models are good because they allow you to use data in a very interesting way as to do scenario testing that a non-model case doesn't allow for. And I think it also allows you to estimate the impact of different impact of different regulations, and how that will affect either issues of systemic risk or institutional risk, and more importantly, the combinations of different policies and so forth that we haven't been able to do. So I believe that those are very useful conversations. You obviously don't always base all your decision making off of those, but I think they're very helpful to start. And then building off of the proprietary based on the individual institutions and goals, and how people manage their different types of assets, I think is important.
Paul, you wanted to come in there?
Well, I think the right outcome, and hopefully the one that will in fact prevail, is a combination of a model-based approach with a standardized approach as a backstop. So I think looking back, Basel II was perhaps overly optimistic in terms of banks' abilities to do internal modeling, and in retrospect perhaps underestimated how far off that could lead. But that doesn't mean elimination. The solution is to eliminate models completely. I think it's models, but with backstops, and also with much more rigorous model approval, which is the current regime we have. So that it's much harder now to be able to use a model to set capital requirements. It's a much more rigorous process now than it was before. So I think there's plenty of there continues to be a lot of importance and need for rigorous modeling, and also not just for regulatory purposes, but for internal risk management as well.
Anyone else want to come in on that one before we have another question? Okay, let's go to somebody who hasn't asked a question. Just by the window there, yeah.
I have a question about capital requirements. So, why are they doing it, I'm guessing?
Okay. If you look at 1987, we had a small amount of capital that was protecting everything. If we then go to 2007, 2008, we had a small explosion back in 1987. 2007, 2008, we had a lot more capital protecting everything, and the explosion was significantly bigger. So now, if you just follow that trend, as we do in many of the other measures that are foisted off on us, would you now say there's so much capital out there protecting everything that the next explosion will erase everything?
That's a provocative question.
Okay, so the question is, if we have an obvious trend in terms of how capital requirements are not helping, why we as the industry do we allow the government to foist this off on us as protection?
Emmanuel, is it protection, or are we deluding ourselves? These hugely increased capital buffers since the crisis, roughly double the amount, say, at JP Morgan.
I feel a little bit like him in that I remember the first financial scandal, which was like in the early 80s when I think it was Chase. Somebody did some small firm that dealt with Chase lost $40 million because you could repo treasury bonds for the full price and only borrow the flat price. And when interest rates came down, somebody arbitraged that difference and eventually lost $40 million that had almost brought down Chase. Now people would laugh at $40 million. And then you get to 87, you get to LTCM, you get to the finally to what Miles said now. And so it just seems like every time there's a problem, everybody lowers interest rates and tries to pump up credit, and the next crash is even worse. So I'm a bit skeptical.
Skeptical about the absolute levels of capital, or
I'm skeptical about the effect of regulation. I'm not a libertarian or anything like that, but I kind of agree with what Miles said in that the trend seems to be more capital, bigger banks, less diversification, and bigger catastrophes.
Is that because we're always necessarily fighting the last war?
Yeah, I think with models, you're always fighting the last war. In the sense, I always used to like to say, if you build a model, you're short volatility. Because you're always trying to capture the world you understand, and your big problem is the world doesn't behave that way. I think markets don't behave statistically. I'm just being big picture, but I think markets don't behave statistically. All the models we use in finance tend to assume that markets are somewhat like coin flips, and coin flips have no memory. But in fact, people learn from their experience and go on to make different mistakes based on them avoiding the ones they did last time. So, yeah. In fact, I was kind of wondering when Miles was talking if there was a straight line correlation between the volume of regulation and the decrease in the number of banks and the size of the banks.
Anyone else want to come in on this?
So great. So
philosophical
it's
question?
not clear that it's the regulation that's driving the size of the collapse, or the correlation's the opposite. So I would have to test that hypothesis a little more clearly before I sign on to that one. But the statement is, what is the right policy intervention to actually mitigate the pockets of systemic risk that you're observing? And because what you've moved from is not just the institutional risk of a Chase collapsing, but now we're looking at systems collapsing, which means that the trillions and trillions of dollars at risk, not just 40 million. And I think that's really what's going on.
And can the models protect us if that happens? Any views from the floor? Yeah, go ahead.
I have a question for Dr. Dermott. So in criticizing modeling in general, well, I guess, like modeling, not necessarily regulatory risk, but you mentioned...
Regulatory modeling is out of my sphere of knowledge.
Sure, but in criticizing modeling outside, with the exception of regulatory risk, what are you advocating for? So you made a statement like, something to the effect of models don't work. People should trust. Like, it feels like you were implying people should trust their gut.
No,
or
no,
something
no.
like this.
I'm not Nassim Taleb. Taleb wants to argue that everybody knows everything with their gut and they don't need any models. I'm not saying that at all. If I wanted to come down here from my apartment, I had to figure out whether to take the train or a cab and figure out project Monte Carlo, which would have the other thing. So every modeling comes naturally. I think it's stupid to say that people don't model. I'm just saying I'm advocating against hubris. And you know, there's something, I'm saying corny stuff because everybody knows it, but I'm saying you write down a differential equation, and I'm only talking about valuation modeling, and you think, oh my God, I can solve it to 3 significant figures, and you think you've done something profound. And you have, and I'm not saying it's wrong, but I'm saying you've got to keep looking over your shoulder to understand that the world doesn't behave that way. And I'm in favor of using lots of different models. And I think I used to sit in on risk committee meetings at Goldman 15 years ago, and they were really smart because they used all these models, but they didn't. They weren't slavishly. They were eclectic about using models, and there were always people who understood the way the world worked and didn't just look at the numbers. And that's what I'm advocating.
Any set of best practices will eventually become a meta model.
Will eventually what?
Become a sort of meta model. Like, you're not, if you codify anything, it's essentially no different from a differential equation, right? If I want to divorce emotion from any decision process, right? Essentially. Am I correct in making this assumption? Would you grant me that?
No, I wasn't saying that. I mean, maybe that follows in some way. No, I wasn't. I'm not sure there is I'm not in favor of codification, because I think as soon as you codify, you're giving people false comfort. So I'm not in favor of codification. I'm in favor of, I don't know what, hiring intelligent people and having them have lots of market knowledge as well as quantitative knowledge. Although if you look at LTCM, they were about as smart as you could get on both sides of that equation, and they still went under. So I don't think there's a simple answer. And I'm also in favor of letting people die when they make mistakes. I think people learn from. I think beyond all regulation, people learn a lot when they see other people come a cropper and go out of business because they took too much risk, or they took stupid risk, or didn't rationally optimize their risk.
Optimal risk?
Yeah,
okay.
so I'm in favor of small solutions rather than big solutions. Armin.
Thank you, and by the way, thank you for creating this, this panel. Great group of experts. At a high level, it seems that every financial crisis has just been driven by 2 things: leverage and crowding. That's a very high-level, simplistic way to view this. Our regulations to date have still approached the problem as if we're looking at individual actors. Let's restrict an individual's leverage, an individual's ability to crowd themselves. And that's useful, by the way. A lot of technology to find one bagged actor who's going to talk about, ripping off this client or doing a poopy deal or whatever it is. That's really good for the individual. But the systemic risk has plagued us for hundreds of years. And yet today, the ability of technology, analytics, together with the enormous cost that regulators have put on the financial system, would seem that for the cost, we could get so much more. I'm really congratulating the fact that with today's technology, we can actually know the legal entities. We can actually identify who Lehman Brothers is. And through enormous ability of industry to get together, we can figure out we should push out repo beyond a day. But from a regulatory perspective, rather than just saying, let's double up the capital and let's just see how much personal pain we can put on people and make them feel miserable for the same amount of misery and cost, isn't there a way to actually map out this thing that we call the financial system as a system, that could be looked at as individual actors, interconnected, and a system that is really no more complicated than, say, a nuclear power plant, but you have all of the data potentially available. You have regulators who can force you to give any data you want. You have banks willing to pay whatever it takes. Why don't we have something better? Why don't we have something better?
Doesn't that entity exist in the form of the OFR?
So, I mean,
no. No, why isn't the OFR doing
okay.
more? And by the way, let me throw the academics in this, okay? Because being an engineer, I'm so used to industry, government, and academia being in partnerships, cahoots, collusion, whatever you want to call it, you know. Whatever it is, there is an enormous amount of investment from industry. There's a clearing through government into academia to do real research, where people focus on how to get to Mars. How much money is spent, you know, curing cancer? How much money is spent by the government and industry to get to Mars? How many PhDs are graduated out of the Columbia Business School to figure out what we can do in academia to solve this issue? And why isn't the press saying more about that? To all of us.
So yes, you can map out the system, and that is actually something very important to do, and this gets you to your optimal risk allocation when you think of it like that way, and because I think it's really important to do so. And that is where models come from, and that's where the benchmarking comes from. So I think that is why models are important, because you can't do that just in the back of an envelope. You really do need something like a model. Okay. There are lots of data that's available to actually do all those estimates, and you're absolutely correct. So this is all feasible. Yes. The collaborative relationship between industry and government and academics in these areas have always been very tenuous. And as you know, the OFR is funded by the banks, and yet they're not funding necessarily academics in that research. So there is a breakdown in that particular case that does not look like the NSF or the NIH,
yeah.
Right? So there are differences in the way in which this is being conceived, and I think that is something that is hampering progress. Yes.
I completely agree with everything you said. I just make a couple of points. One is I think there is rapidly growing academic interest and a lot of work being done in the area. Second, from the point of view of the OFR, well, and I think the way the government could be doing this is part of the stress test, right? You're already running a stress test exercise. Instead of doing standalone consequences of a shock to the system, run that shock through the financial system and see how what's happening at one institution impacts what's happening at another institution. So you already have the vehicle for doing it. But where the two places where I maybe would be less optimistic or I see bigger challenges, first, I think it's very difficult to model. I think it's much more difficult to model than a nuclear power plant. Not that I know anything about modeling a nuclear power plant, but it really does seem like nobody knows the right way to approach the problem. Which doesn't mean it isn't worth trying really hard. And second, the data is a bigger challenge than you might think. And unfortunately, there isn't a lot of data sharing within the regulatory world. So you have the data that you would need to actually do this, different parts of it sit in different agencies. And although the OFR has a mandate to have all that data, they're not there yet. And hopefully Congress will still give them the chance.
But let me take the counter to that. What is the NIH budget? What is the NSF budget? And what is the cost in the financial industry? To a first approximation, the financial industry has twice as much capital trapped because we just don't know better. That's why your ROEs are single digit. That's just why. not knowing better, let's just keep ROEs, let's just keep twice as much equity, causing hundreds of billions of dollars, right, of cost in the system. What is the NIH budget? What is the NSF budget? The collapse of the financial system could be worse than cancer. Where's the money coming to fund real academic research, coupled with industry, coupled with government regulation informed by both? Why isn't that happening? The money is there, right? Why isn't it happening?
I think the analogy with the nuclear power plants, I agree with Paul. I think it's a little deceptive if I okay, but anything mechanical, because if I push this bottle, it moves. But if I hit Paul, I don't know whether he's going to punch me back or whether he's going to turn the other cheek. So I don't think there's the same.
But Emmanuel,
yeah.
But I can ask Paul, how much will it hurt if Emmanuel punches you? I can ask
He doesn't know.
No, I can, that's the point of the stress test. When you pointed out valuation, certainly we are not sure of valuation, but we do know where all banks would value the same security. And so if you price it at 100 and you price it at 94, I think there's a problem. As a regulator, with all of that data, I can force all of those questions to be much more visible than we ever could before. But sitting from at least the seats that we see, we don't see regulators using that transparency, forcing that transparency to find out that, you know what, if Emmanuel hit Paul, Paul would say ouch, and Paul would punch back Emmanuel, and we didn't realize that Sharyn actually was keeping her, iPhone in your jack pocket, and that actually broke the iPhone, and then we didn't realize that we went over for the day because I've been talking too much. You follow what I'm saying? I think that it certainly is complicated, but we're talking about hundreds of billions of dollars that are going to waste. It's not like, 5 million, so.
No,
I don't know if there's an answer.
And it's not just that the money is sitting in the banks, but that's money that's being frozen and can't be put to productive use in the economy, which therefore means that you have slower growth, you have increasing income inequality.
Yes.
We can go down the whole list of evils of which are just accentuated as a result of it. And therefore, so Donald, did you wish to add?
This will be the final question.
Yes.
Well, it's not so much a question as a comment. Of all the problems humanity has solved, this is not the hardest.
Yeah. Yes.
Either from an engineering perspective or a human perspective. It's difficult, okay?
Yeah.
But there's only 3 or 4 ingredients. One is the standardization of trade data, so we can share positions. At least somebody can see positions across institutions. Standardization of market data inputs, pricing models, and then some sort of, not necessarily a consensus, but at least a democracy or challenging around risk models to assess possible impacts, whether it's stress testing or stochastic based or standard rules based. Frankly, let's get them all out there. So I still haven't understood why the problem is, I'm with you, I don't understand why the problem isn't solved, but we have to make concrete steps. I think democratization and open source is part of a concrete step for solving the problem.
That's a very nice way of wrapping it up, unless any of our panelists want to have the final word. All right, well, nicely done. Thank you.
Okay.